Hey everyone, today on the final bar, stronger retail sales, continued geopolitical uncertainty means a choppy market with the S&P 500 finishing slightly lower for the day. Value over growth continues to be a theme as the market digests earnings from some of the major banks, including Goldman Sachs, Bank of America. John Kosar of Asbury Research will be joining us live from Chicago. What does his Asbury Six Market Model tell us about the current market conditions? Ladies and gentlemen, this is the final bar. Hey there, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The technical analysis toolkit really designed to focus on the markets themselves. What evidence can we glean from price action, from price, volume, sentiment data, all of those things that tell us about the investor psychology, right? The mindset of investors as all those buy and sell orders sort of bubble up into price changes. And by measuring those using indicators based on momentum and sentiment and breadth, we can start to make some well-informed decisions about current market conditions and some expectations about what may come next. Now, the market arguably in a very uncertain, sort of cloudy time. I'm excited to talk to someone like John Kosar today. His Asbury Six model was something I would love to revisit just to see the conditions. Sort of an interesting moment. I'll let John tell you about what the market model is looking at now and what he would need to see to lean more bullish or bearish. Overall, we're in that limbo between the 50-day and the 200-day moving average. A lot of individual stocks sort of in a similar boat as well. Let's get to the market recap and see how the charts have evolved today amidst all this global uncertainty and also look at some of the individual names reporting earnings. Before we get there, I do want to answer a poll question. We asked you, where will ExxonMobil, ticker XOM, be 1 month from today? 10% higher, 10% lower, or somewhere in the middle? Kind of a bullish reaction by Final Bar Nation in terms of the direction of Exxon. It looks like, 80%, 4 out of every 5 saying at least higher 1 month from today. Let's look at a chart of ExxonMobil. I would tend to agree with that assessment as well. And I'd probably go with the at least 10% higher bucket, which was the most frequent answer out of our poll respondees. Thank you so much for responding to the poll. ExxonMobil, right, just back above the 200-day moving average this week, which I think is interesting. The energy sector, certainly in the third quarter, strongest place to be, I would argue, among strong places if you filter down. Energy, some of the stronger areas of the market. ExxonMobil actually threatening to make new all-time highs. When you're looking at a big name like this, particularly a value stock, I always like to look at the unadjusted data. So you do _XOM. It's a higher yielding name. And so as a result, you're looking at the pure price action going back over time. If you look, ExxonMobil, a pretty consistent resistance level, right around $120 a share. Look how we hit that in February. We hit that again in April. We hit that again here in late September. Now we've pulled back down toward the lower end of this basing pattern. What's so interesting is the chart of ExxonMobil, literally a range bound, a sideways market from November of last year really through this week, right? We're not too far right now from where we were in October of 2022, which means for the last 12 months, ExxonMobil's been unchanged if you look at the price action. What's interesting, or what would be interesting, is if we could find a way to get above that resistance level. Anytime you have a consistent level of resistance that has been tested a number of times, sort of further validating that that is the ceiling for now, that tells me Exxon above 120 is a pretty impressive chart, because that means anyone that bought during this period, all of a sudden sitting on some paper profits, that can usually cause some renewed optimism or an influx of additional buyers recognizing the new strength in the stock. So what's interesting is I think if that first option, I think between 0 and 10% higher actually plays out, I wouldn't be surprised if we go up more than 10% to continue to break out of that basing pattern. Energy stocks, certainly an interesting area, pulling back here in October, but overall, again, I think breaking above that resistance could be a good vote of confidence for ExxonMobil and others. Let's continue with our market recap and look at how the markets played out. I mentioned the S&P slightly lower. As we were going live with the show, I'm watching this spike going into the close, looking at the teleprompter with what I was going to say, and I'm thinking, what, are we actually going to finish slightly lower? We did, but by a penny of a penny here. The S&P finishing the day pretty much where it started yesterday, 43.73 is the close as we're observing it here. The Dow finishing just slightly below 34,000. That's also flat for the day. The NASDAQ Composite actually finishing just slightly in the red, down about 0.25%. So really not a terrible directional day for any of the major markets. If you look at the mid cap and small cap indexes, both up about 1.2%. That lack of participation in small caps has been an interesting theme we've been observing and talking to a number of our guests about. And again, so for today, if you look at the sectors that are up, things like energy, materials, financials, that's what's going to allow small and mid caps to do a little better than our growth-oriented benchmarks of the S&P and the NASDAQ. So pretty much playing out as you might expect here through the course of the day today. The VIX pushing higher, up about, we'll call it 0.7 to 17.9. Back of the envelope calculation for the VIX, in my opinion, VIX below 20, things are not that volatile. VIX above 20, things are getting volatile. And we've teased that 20 level here a couple times, have not really broken above it for this run. This part of the cycle. So I think continuing to watch VIX above 20. I have an alert set on stock charts for if and probably when that plays out. I don't know when that will be, but I will certainly want to be aware when it finally does. Interest rates all moving higher today. So the whole yield curve sort of drifting to the upside. The mid and long year points coming up in a significant way. Also the 5-year point, to be honest. 10-year yield finishing around 4.85. The long bond yield just below 5% at 4.95. So bond markets, the bond prices, that is, like the TLT, the AG, LQD, which is a corporate bond ETF, all in established downtrends. A lot of them bounced up recently, but a day like today sort of reinforcing the overall downward trend that we've seen in bond prices. Yesterday, one of our 3 and 3 charts, stock to bond ratio, and I feel like I bring that up about once a month just as a reminder, stocks continuing to outperform bonds in uptrends, in downtrends, doesn't seem to matter. Just bonds are overall in a pretty strong position of weakness, I would argue, when you look at the overall bigger picture with asset classes. Dollar, not too much of a change from yesterday, to be honest with you. Looking at the commodity space, overall more green than red here. You have the GLD up slightly, up about 0.2% to 178.30. Silver prices up a little bit more. Oil prices up as well. In the energy sector, as I mentioned, the top performing sector for the day. Yesterday, Bitcoin, Ethereum had that crazy spike. We talked about that in a little bit of detail on yesterday's show. So if you missed that, make sure you check out yesterday's episode. We talked about that spike in Bitcoin. Basically, it was a false announcement that ended up being untrue, that a Bitcoin ETF had been approved. Finally, was not the case. And so there was sort of a sudden reaction and then sudden after reaction. At the end of the day, no real change now from where we were before that news came out. Bitcoin currently sitting around 28,500. Ether prices down today around 1565. Looking at the 11 S&P sectors, you have energy, materials, financials at the top of the list. Energy up 1.1%. Materials just behind there up 1%. Do you see a theme with any of these particular sectors at the top? These are more of your value-oriented sectors and not defensive sectors necessarily like consumer staples. These are more of the sort of value leadership, right? Sort of the cyclical sectors like energy, materials. Industrials had been higher, actually came down going into the close. At the bottom, you have some defensive sectors like utilities and real estate, and also one of the growthiest sectors, technology, down about 0.5%. As a quick announcement, tomorrow our episode, I'm going to be on the road, actually, travel day for me, so just recorded an episode for you looking at the Magnificent Seven and friends, some of those key mega cap stocks. We'll talk particularly about mega cap technology, mega cap communication services, mega cap consumer discretionary, how they're related and how you might rank them from 1 to 8. So don't miss tomorrow's episode as we go through those charts in a little more detail. Let's look at a daily chart of the S&P 500, just sort of see where things are at. And again, if you look at the sort of trading range of the last, 1, 2, 3, 4, 5, 6 sessions, they're about the same, right? So we sort of spiked up. This was the end of, the week prior, and then we spiked up Monday, Tuesday, Wednesday, Thursday, Friday, now Monday, Tuesday. So really for the last week, the last 6 sessions, we've been basically in this little range, sitting just below a declining 50-day moving average, sitting just above this trend line from the major lows over the last 12 months. We're kind of right in the middle. If you look at the range over the last 6 months, we're kind of right in the middle of that range almost. So I think we're trapped between a number of things. We're trapped between a declining 50-day moving average and an ascending 200-day moving average. We're trapped below price support on the downside, trendline resistance on the upside. We're sort of in the middle. The chart of Tesla, I feel like, comes to mind as a great example of the environment that we're in right now. It could break either way, to be honest with you. Theoretically, the market could move either way from here. I think it's all about just waiting to see which way that move actually plays out. Overall, I'm inclined to watch the momentum characteristics, and I can't help but notice that for the last couple months, the RSI for the S&P 500, right, this measure of momentum, more in the bearish range than the bullish range. The breadth conditions, more negative than positive by my quick assessment. So overall, I'm inclined to think of the direction of the market as down until proven otherwise, but we're kind of at the upper end of where it might actually be proven otherwise. Great guest today, by the way, John Kosar, as I mentioned. Very interested to get his take on what we're seeing here and what may come next for the S&P, what he would need to see. Speaking of uptrends, 10-year yield certainly in an uptrend. And again, classic Charles Dow analysis, what we call Dow theory. Is this chart making higher highs and higher lows, or lower lows and lower highs? It's pretty clear that bonds are in a downtrend over a period of months. Clear to me that interest rates are in an uptrend. And again, with all of this discussion and debate about future Fed policy changes, about future rate hikes, or when they would start to lower rates and what that all might look like, while we're all having those discussions, rates continuing to push higher and higher. Every month in 2023 since April, the 10-year yield has made a new high for the year. So you're continuing to see rates go up. And again, I'm inclined as a trend follower, my general approach is to assume that a trend persists until proven otherwise, right? What would I need to see on this chart to tell me that the conditions are changing? Not making new highs would be a start. Overall this week, we're once again making a new closing high for the year on the 10-year Treasury yield. So certainly an uptrend that I think is in healthy shape. If only we had stocks that looked like this, wouldn't be too bad of a portfolio. To finish off our market recap, let's look at some of the stocks that have been reporting earnings here. I'm going to use our ACP platform for this. And in case you're not familiar with this, or in case you haven't seen me use this before, just to orient you, on the right side, we have a weekly chart going back about 5 or 6 years. The lower left is our daily chart, which we'll often bring up just to look at a little more detail, and then come back. And in the upper left, just a candle chart, just to look at some of the short-term dynamics, where we're at relative to some key moving averages. Let's talk about some of the stocks that are reporting earnings this week. This morning, we had a lot more financial stocks coming out with their earnings report. What's interesting is if you look at the data, if you listen to the earnings calls from Goldman Sachs, Bank of America, they're talking about strength. They're talking about beating estimates, which is all, I think, encouraging. But you also have to remember something like Goldman Sachs unwinding their whole retail business. There's a lot of changes underneath the hood. So if you look, it's certainly a challenging environment for banks, certainly given the interest rate environment. And if you look, I mean, what does the chart of Goldman Sachs tell you? Nothing too great just yet, right? This was today. This was an opportunity with, as I destroy the chart, here we go. With something like earnings on a stock like Goldman Sachs, this is something at the lower end of the range for the last 6 months. Something like a good earnings announcement has the opportunity to propel a stock like Goldman Sachs that has been languishing, up to retest at least the upper end of the range. But if you look, it really wasn't to be. You're still trading down through the course of the day. It was a down day for the stock, down about 1.6%. And overall, not a lot of upside follow through. So I think the sentiment on Goldman Sachs, based on that, based on the reaction to earnings, pretty muted, right? I mean, I think pretty weak at best. Now, compare that chart with the chart of Bank of America. A little bit of a different feel over the last couple weeks. Bank of America actually made a low for the a swing low here in last week, early October, and now starting to rotate higher, actually bouncing, making a new swing high, getting closer to that 50-day moving average. So a little bit better, but still, I mean, is this a great chart? I would argue not so much, right? The momentum is still more in the bearish range. You're bouncing off of a new low, but you're bouncing off of a new low, right? We're just coming off of a new swing low. So most recent pattern on something like Bank of America, in my opinion, is a breakdown. Now the weight of the evidence more bearish. You're looking for signs of a bullish rotation. So reclaiming a 50-day moving average would certainly be encouraging. You see between these two stocks, Bank of America bouncing higher, Goldman bouncing lower on their earnings before the open. Look to see if there's further upside. Can we make a higher low? That's the real question I'll be looking for on a stock like Bank of America. NVIDIA, a key name, and I mentioned the special we'll be doing tomorrow. I'll be on the road, but we'll talk about the Magnificent Seven stocks. I think NVIDIA is a crucial chart right now. Trading lower today ended up being a bit of a doji candle, which could mean short-term bounce over the next 1 to 3 sessions. But today, a pretty big down day, down almost 5%. And this neckline, if you take the head from early September, the left shoulder in July, the right shoulder now in October. Now that we've rolled down, this certainly looks more like a pretty classic head and shoulders top. That's validated with a break below the neckline. So you need to get NVIDIA down below, we'll call it 410, 415. That would complete that topping pattern. The S&P, as you know, has a head and shoulders top, which has been broken, right? We broke down through that neckline. Stocks like NVIDIA holding above their neckline would be sort of a bullish argument that things are not getting that bad. But an NVIDIA breaks down below 415, maybe down below 400 to get it to a new swing low for the last couple months. I think that could be a really negative development. Other stocks sort of to talk about on the move. Western Dig, one of the movers today, down about 3.5%, right down to the 50-day moving average. That's just what I wanted to highlight. Not that the 50-day moving average is my favorite trading system of all, but in general, a stock like WDC, you can see in a downtrend, you often have these counter trend rallies up to a declining 50-day moving average. Once you rotate into an uptrend, you often see pullbacks to an ascending 50-day moving average. We did that back in August. We did that back in July. Did that back in late June. We're doing it again. And so the question is, does that ascending 50-day moving average hold? If so, this is one of those great buy on the dips kind of setups, right? A strong uptrend pulling back to a short-term level of support, maybe setting up for that next move higher. But if you're buying into this sort of pullback, as always, I would keep your stops very close to home. I would think about how you're managing that downside risk. Again, with an uncertain market, with certainly a possibility of the S&P, the NASDAQ, going further down, breaking down. Make sure you keep your risk clearly defined and make sure you minimize some downside impact on some of those names. That's it for our market recap. A lot to talk about and a lot of movements here, particularly on the interest rate front and a lot of earnings. Don't forget tomorrow you have Netflix and Tesla after the close. Two key names to pay attention to, part of that Magnificent Seven group of stocks. Before we bring on today's guest, John Kosar, a couple brief announcements. And mainly it's to remind you, we are listening to you and we are here for your questions. You have a number of different ways now to share questions that come up as you're watching our show, as you're using the Stock Charts platform, as you're just trying to make sense of these markets using charts. We're here to answer your questions. Our email is thefinalbar@stockcharts.com. On X, just tag us in a comment @FinalBarSCTV. Here on our YouTube channel, you have a couple choices. Put a comment below the video that you're watching. During a live broadcast like this one, just use the chat. We'll be looking for questions there every day. Any of the questions we don't get to, we'll put them in the mailbag. We'll do a mailbag episode this Friday, and we'll be drawing a lot of those questions from what we get during the show. So make sure you use our chat, and we'll look forward to hearing from you. By the way, Mondays now going forward is a live Q&A. On Monday's show this week, we had a lot of fun doing the live Q&A right as part of the Final Bar. A lot of really thoughtful questions. So make sure you tune into Monday's episodes right after the close at 4 p.m. Eastern. I want to bring on today's guest, John Kosar. John's been a longtime friend of Stock Charts TV, a frequent guest on the Final Bar, and also a guest host frequently of Your Daily Five. He's the founder of Asbury Research, coming to us from Chicago. John, good to see you. How are you?
Great to be here. Very interesting times. Looks like we're starting to coil up for a nice move here.
I feel like they're always interesting times, right? But especially now, and I think a lot of questions in terms of the overall market structure, a lot of uncertainty. There are a lot of headlines flying around about a lot of different things. We had retail sales before the open today, so sort of like competing narratives all around. When you take all of that evidence and then focus on the chart of the S&P, what stands out to you?
Well, you had mentioned it. We're in the midst of a major uptrend that started back in October of last year. And the support, you can see it on the right part of your chart. We've got the high from February of earlier this year, a straight horizontal line there. We've got the trend line going back from October of last year, sloping upward. And the third is we have the 200-day moving average right there. So if you look at all those together, it's basically 43.05 down to 41.95. So about a 200-point, call it a cluster of three different levels. That is where, in my world, that's where the value is, because we're close to the support. The market goes up most of the time. So this is where you can buy and have a relatively low risk. And assuming the market goes higher over time, you have an open-ended upside. What we have to get through right now is that it's 43.99. That's the 50-day moving average. And there's some other minor levels there. You have a gap where we gap down. If you slide right over, that gap is right there too. So I think that's really the trigger. And if you look at the trading for the past week, we have bumped up against that all week long. So the market obviously sees that, and something needs to encourage enough traders to have the guts to step over the line, so to speak, and get up above that resistance.
It's so funny. I feel like a lot of conversations in market strategy circles are talking about what the market should do, right? It should go up, should go down based on these different things. You look at the last week, we really haven't gone anywhere, right? We sort of gapped up, and I'm glad you pointed out that, that gap that we've sort of traded up to. So we're sort of right at an interesting point. I know we're going to get to your Asbury Six in a little bit, but what on this chart would make it look a lot worse? And what I mean, maybe to rephrase, is there a level, is there a signal out of those things that you described that would tell you, okay, this is starting to get really negative and you want to start getting defensive? Like, what would that red flag level or signal be for you?
I really think it's 4,200. I think you have to give this a little bit of room, especially given the uncertainty. All of these, we've had big ranges the last 5 days, right? We're up 40 in the morning and we're down 40 in the afternoon.
Yeah.
So the market clearly, there's a lot of trading intraday, but nobody wants to step over those lines. But I think the answer to your question is 4,200.
Yeah, really, really good point. Your second chart is looking at volatility, looking at the VIX. We've talked about the VIX, remaining below 20 now for quite some time. When you're looking at the chart of the VIX, what does it tell you about the conditions here?
Well, it tells you that it's leaning down. We look at VIX as a tactical tool. So we use a 21-day moving average, which is a business month. That's Asbury's tactical time period is 1 business month. So you can see the VIX got up above there mid-September, early to mid-September, got up above the 21-day. And with very few exceptions, it stayed right there. And in the meantime, the S&P 500 has gone sideways, but it had a little bit of a downward lean there for the past couple of 3 weeks or so. So for me, when the market's coiled up like it is now, and you're looking for the indicator that's going to give you the first and fastest indication that it's made a decision, I think the VIX is the best one that I know of. So if the VIX gets back underneath 1746, 1750, let's call it, stays there, that's the launching pad to get up above that 4,400 area in the S&P 500. As long as the VIX stays, and it isn't elevated, you had mentioned it really is, 20 is elevated. But if you're looking for a tactical leadoff, we need to get back below 1746 and stay there in order to tell me the market has lost enough day-to-day fear to make that happen.
Yeah, really good chart. And I love the 21-day moving average there. It's not something I've normally looked at. It's really interesting on that tactical time frame. Can we dig into your Asbury Six model? I know when you've come on the show previously, this has been a really interesting way of thinking not just about the technicals, but how it relates to some other things like market structure, bond markets, fund flows, and all of that. Can you talk us through this model, what it's telling you about the conditions here?
Sure. The reason I started using this, I kept it internal for years, but you and I have been around for a while. There used to be a day where you could look at the S&P 500 and 1 or 2 indicators, maybe volume, and you could have a reasonably good back of the envelope idea of what the condition of the market. You can't do that anymore. Look at this week. We're up 40 in the morning. We're down 40 in the afternoon. You can't do that. And you get faked out of really good ideas. So I said, okay, what can we do to see what's going on under the hood of the market instead of trying to chase the tail of the market as the algos are having fun with us during the day? So I came up with these 6. We back tested 6 that worked really well together, like the 6 people in a hockey team, right? If one of your guys falls down, someone else will come up and pick up that check. That's what this is supposed to do. So we've got the rate of change in the S&P 500, the relative performance of stocks and high yield bonds, investor asset flows, which is the AUM in the spider. We have high yield corporate bond spreads. We have trading volume, and we have market breadth. So we use those all together. And right now, the takeaway is telling me that under the hood of the market looks just like it does on top of the hood.
Yeah.
It's sideways. The market's sideways. It doesn't really know what to do here. And you're even seeing that in these secondary indicators. So what am I looking for? The metric itself has been negative since September the 18th, when there was 4 or more that were red. The numbers in those cells are the dates that those particular metrics flip to red, which is negative, or flip to green, which is positive. So the one I'm really watching like a hawk is the investor asset flows in the spider. We had a pretty flat day today, but if I see a little bit more conviction, in other words, the AUM starts to grow. So people are saying, even though the market's been flat for a week, I want to buy them today and hold them, take the overnight risk because I don't want to chase it tomorrow. That can flip this positive. And if it does, along with the VIX, that's another fast twitch kind of methodology for me to figure out where we're leaning when we're in a really kind of a tight space. One more thing I wanted to throw at you as you were talking, I was looking at Tesla.
Yeah.
Tesla is sitting right underneath this trend line that dates all the way back to November of 2021. And it's been there. It's been all of these little bumps at the right part of the chart are the last three tests.
Yeah. Right.
I did a quick check. The linear correlation between Tesla and the S&P 500 has been a tight and stable 0.8, 0.9 for the past decade. Looking at 10 years, 5 years, 3 years, 2 years, 1 year, 6 months, 3 months, all the way through the series. So Tesla, we got earnings tomorrow, right? If those earnings are bang up and we jump over that line, the party's on. I think that's going to be a really good indication that we're going to have a good seasonally expected fourth quarter.
Yeah, see, I've been talking about this little coil pattern, this symmetrical triangle. John, you've supersized this now and talked about this trend line, this multi-year trend line. A lot riding on Tesla's earnings this week. That's really, really interesting. You mentioned seasonality there at the end. When you look at the seasonal trends, obviously a lot of times we see a major low in October, but November and December actually tend to be pretty strong for stocks. For you personally, how much does that seasonal tendency fit into your outlook, here in October of 23?
It's a great question. I get it asked all the time. I look at, like, if you think of the trend as riding your bicycle down the street, seasonality is the wind. It could be at your back or it could be in your face. I don't think seasonality is ever enough to overcome, what's going on with the Fed or what's going on with geopolitics or whatever. But I look at it as something that could either dampen a move if it's in your face, and in this time it's at our back, right? So we get a breakout here, we get a move down in the VIX, we get some expansion on the AUM and the spiders. Any of that stuff, now we've got the wind at our back for the next 2 months. So that's how I look at that.
Brilliant analogy, the bike riding analogy. I like that one, John. That's a good one. All right, so one more question then. Given this sort of uncertainty, this sort of mixed result that we're in, this uncertain time, your Asbury Six model kind of neutral, what sort of bets would you be comfortable taking? Is it when this is the conditions that you observe, is it a sit on your hands and see which way we break? Or are there opportunities that you're observing now that make sense even with the uncertain environment?
I'm invested here. I just did a year daily 5. I'm looking at it now, October the 11th, and the title is Major Buying Opportunity is Emerging. And the reason that I say that, I can't tell the future just like anybody else can't. But the risk reward down here at 4,200, you and I were talking offline, there's an inverse head and shoulders pattern that appeared in the summertime, spring, summer. There it is. And we broke out of that in May. That target's 4,800, right? So we're at 4,350. You risk 4,200. If we go to 4,800, I think the all-time high is 4,827 or 4,830, something like that.
Yeah, right.
That's about 3 to 1 in a seasonal time where you're likely to get a little bit of tailwind as that seasonal trend is going through the end of the year. Actually, it goes in the early part of January. So for me, it took me 40 years to figure out that I'm not smart enough to be able to tell the future. So I'm looking at all of this stuff in terms of where's the risk reward, where's the opportunity. And the setup is 4,200. If you're wrong and we go through 4,200, something happens, interest rates get over 5%. I think that could do it. But in the meantime, you've got some risk reward right around 4,200.
Well said. And thanks for talking about the relationship between some of those different patterns, John. That's awesome. Good to see you. Thanks again for coming on the show today, John. Stay safe, be well there in Chicago, and we'll talk to you again soon.
It was great. It was good to see you.
That's John Kosar. John's the founder of Asbury Research, coming to us from Chicago. And I love that discussion about the model, right? His Asbury Six model, which really looks at not just the technicals, but some other things as well, right? More market structure, more sentiment, more fund flows. But at the end of the day, it's all looking at the market conditions. And I love that comment about the model is neutral, but when I'm looking at the risk reward, there's better opportunity on the upside than there might be risk on the downside. I think that's a really good way for intermediate term, longer term investors to think about a market like this. With all its uncertainty, what are the risk versus reward? Great concept. And I love that bike riding analogy, which I will gently borrow from John. I think that's well said. Great take there as always by John Kosar at Asbury Research. We've got to wrap the show, folks, and go to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. You know, I was looking at some of the breadth data earlier. I was sort of preparing for the show and just digging through some of the breadth indicators that I have on my main chart list. And one of the things that caught my eye was the new highs versus new lows. So this chart is looking at the S&P 500 in the top, just daily going back for the last 12 months. This first panel down is looking at the new highs in green and the new lows in red. And this is looking at New York Stock Exchange highs and lows, 52-week highs and lows. So green means a new 52-week high, red means a new 52-week low. Look at the new highs that dominated in June and July as the S&P is pushing above 4,200, breaking above those February highs, going to new highs in June and July. Look at how that started to dry up, and all of a sudden you had stocks making new 52-week lows. Not just a new swing low like the S&P did, but a new 52-week low, which means those are the names really going down. These are the media names like a Warner Brothers Discovery or Disney, some of the consumer staple stocks breaking down. Those are the types of stocks getting down there. But look at how much we've seen more and more new lows than new highs. And the bottom series actually just shows you the net difference every day, new highs versus new lows. So black bars mean there were more new highs than new lows on that particular day. Red bars means more new lows than new highs. Look at all the red that we've seen from mid-September through mid-October. There have only been 3 or 4 days in the last couple months where you've seen more new highs than new lows. And so those conditions, to me, tell me we're still in a downward phase. The bull case from here means more green, less red, and the histogram tilting more towards more new highs than new lows on a given day. Those leadership names, those early leaders have to start breaking out to rotate that more to a bullish configuration. Chart number 2, looking at the financial sector. A lot of banks reporting earnings last Friday through the course of today and continuing on through the course of this week. I'm looking at the XLF just year to date, and I focused in on Fibonacci analysis. I had some questions recently about Fibonacci retracements, and this was a really good example that I found just showing you the relationship and how it often comes out. If you look at the low that the XLF made in the first quarter, if you look at the high that it made in July, 38.2% of the way down is the August low, 61.8% of the way down is the October low. So it actually played out perfectly using this traditional framework using Fibonacci analysis. So overall, we're in a downturn where we keep testing support, but we've now bounced off of this key level called around 3220, which is that 61.8% retracement level. Now we're really close to flipping this back more positive. And the reason why I would say that is we're testing the 38.2% level. We actually pushed above it this week. We're testing the 200-day moving average, which was also support here in August. It was resistance in September. Now we're maybe getting back above there. Can we get above the 50-day as well? So we're sort of at that point where we're up at the upper end of this range, and I'd be very keen to see if earnings this week can propel the XLF to a new swing high and getting back above moving average resistance. Finally, this chart, if this was a stock, and it is not, but if it was, would you feel comfortable owning this? I would argue probably, right? Higher highs, higher lows above 2 upward sloping moving averages. The momentum consistently strong, right? On pullbacks, the RSI is kind of bottoming out around 40, 45. The relative strength is strong. This is outperforming the S&P. Of course, this isn't an individual stock. This is the 10-year Treasury yield, right? $TNX. But if you think about this chart in terms of the trend, the momentum characteristics, I would argue clearly in an uptrend. And what I have learned in my experience is trends tend to persist until something changes, right? And either the market tells you the conditions are going to be different, all of a sudden the buyers and sellers start to change and things start to revert. But overall, this is still a trend of higher highs and higher lows on strong positive momentum. It's telling me interest rates continue to go up for the foreseeable future. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the Final Bar. A special thank you to John Kosar of Asbury Research joining us from Chicago. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.